Welcome to the Introduction to Transfer Pricing. This is a series of short videos covering the fundamentals of transfer pricing. In today's video, we're going to be discussing the transfer pricing methods. These are the most commonly used methods as they're described in the OECD guidelines or in the US regulations. Well, let's start from the example that we've used in most of our videos thus far. We have Japan Co., which is a related party to UK Co., and it's selling products to them, 10 units of product at £7 per unit for a total transfer of £70. Now the first thing I'm going to do in this example is I'm going to give you a bit more detail about the manufacturer. I'm going to take the total cost of 60 and split it between what is their cost of goods sold and what are their operating expenses. So now we have a bit more detail, and it provides us a few more options for how we can think about the transfer pricing problem. They have cost of goods sold of 40 and operating expenses of 20. So the financials in total haven't changed at all. Japanco still earns an operating profit of 10, but now we know what the details are below it. Well, the first approach to establishing that the £7 per unit is meeting the arm's length standard, or that price that would have been charged between two parties who were not related to one another in a similar transaction, is to look directly and to ask the question, do we ever observe the sale of this same item? Let's just call it widgets for now for convenience sake. Does anybody else sell widgets? And if they sell those widgets, do they sell them at £7 per unit? This is referred to as using a comparable uncontrolled price, or CUP method. It's probably one of the most compelling arguments one can make in transfer pricing, is that if you do have a good comparable uncontrolled price or a good CUP, it's very hard to argue that the price would be different than that. So let's talk briefly about what goes into a CUP analysis. For example, what if the item being sold were a television? Now, for the uncontrolled price to be comparable, the TV would have to be very similar. Can we find similar TVs? Well, let's just as an example here ask the question, could we find a similar TV to a 46-inch LED TV with built-in Wi-Fi and 3D with 1080p resolution? Well, if you went off and you did a search on Amazon, you'd find out that to start off with, there were 2,876 different LED TVs listed on Amazon on September 17th of 2014. But of those, only 388 were between 44 inches and 49 inches, and we know that's a very important factor for comparability. And of those, only 325 had the 1080p resolution, and then come down to only 8 were built with Wi-Fi built-in and 3D. When we look at those 8, which are completely comparable to the ones that we want to find, so it's comparable on all, we find that 2 of them are actually not new TVs being sold, but used TVs. So we reject those as not being comparable. That'd be another important feature. Well, if we narrow it down to those 8, we find out we have some pretty interesting number on their prices. Now, to start off with, there was one outlier at $3,500. I didn't do any further digging, but I'm sure that if I really dug into the features on that TV, that I'm going to conclude there's probably something about it that makes it non-comparable. But of the others, you notice that there actually is a pretty reasonable range, and often in transfer pricing we use either a reduction in the range, an interquartile range, or something else that would reduce it. And if you notice here, if you concluded that the arm's length price appeared to be between the range of $1,100 to $1,200, I'd agree, and I think that's actually a pretty tight range for the price of the TV. So it goes to show that one approach to trying to apply the CUP method is to find very comparable transactions. And here, what we've done is we've narrowed down the set of all possible comparable transactions to those that are truly comparable on size and features and the fact that they're new, to come up with what would be a reasonable range. So, as I've said, one approach is to look for all the transactions that are very comparable on all features. A second approach, which is not done as often but really ought to be considered more frequently, is to identify transactions that are not perfectly comparable, but that adjustments could be made to those transactions to make them comparable. Here's an example concerning used cars, and this is real data. Imagine that you want to determine what is the price between two related parties. Say you're selling your used car to your brother. And in which case you'd say, well, that's a related party transaction. And the car happens to be a 2010 VW Beetle. Now, if you go out and you look at the cars that are being offered for sale at the moment on a common website, here are all the Beetles, and I've picked up various important features that I think might affect their price, their body style, whether they're convertibles or coupe, what year they were manufactured in, what their mileage is, and then what's the going price or being asking price at least at the moment. It would be a little bit better if we actually had a price at which transactions took place, but this is a good starting off point. The first thing you might notice is that there are no 2010 cars for sale. Well, that could be troublesome. And in fact, it's even worse that there are actually no 2009, 2010, or 2011 cars for sale. That said, many people would see this as a problem. They'd say they can't find a comparable, so they'll go to some other approach or to solve this transfer pricing problem. I would argue differently. I would say it's really a problem of needing an adjustment. If you run a regression on trying to explain what causes variability in pricing, you'll find that nearly all the variation in pricing is explained by the age of the car. Well, with that information and the regression results, I was able to make an adjustment to make these numbers work fairly well for determining what would be the expected price of the 2010 VW Beetle, just in case I had to sell it to my brother, who's a related party to me. From the regression analysis, what we determined is that the car's price falls by about $1,414 per year. I'm sure that's just an approximation, right? We all can talk about how much cars depreciate in the first year, but using this data for all of these different used cars, and remember they've already used cars, so they've depreciated pretty much, that first year's loss is gone. We find that we can adjust each one of these for this difference. So what we do here is we take the number of years difference between the car's actual manufacture and 2010, the year of manufacture we want to estimate, and we multiply that by the adjustment per year, or the 1414, subtract that off of the offer price, say in that first line, which would be $20,815, and we find out that the adjusted price, had that car been a 2010, would probably have been $16,573. We do this for every car that we can make an observation for. And then what we look at is we say, well, this is a wide range of results, but let's look at the interquartile range and see what answer we get. And the interquartile range, which is frequently used in transfer pricing, shows that the price of a 2010 VW Beetle, we'll probably also note within 50 miles of my home zip code, ranged from $14,075.50 to $16,815, with a median, or the 50th percentile, being $15,198. Well, that's not a bad range. That actually narrows it down a good bit. And if you transacted at the $15,198.50, you'd have a very strong argument that that transaction, when you sold the car to your brother, happened at a arm's length price. The cup isn't the only approach we might take. Another approach we might take is to ask the question, well, if the UK is selling these goods, what if it sells goods that are similar but not identical to the goods that it's buying from the related party and reselling? So for example, if it were buying televisions from the related party, what if it was buying DVRs from an unrelated party and it's selling those? In which case we might ask, do they earn the same amount of gross margin when they sell a TV versus selling a DVR? The products are fairly similar. They're probably being sold in the same showrooms by the same salespeople. They take up the same space in the warehouse, etc. All these things coming into play. If they earn the same gross margin, it would be indicative then that they're probably not overpaying or underpaying for the TVs that they're buying from their related party, because they're earning a good margin on them, the same margin they'd earn if they had bought things from unrelated parties. Another approach is to look at the operating profitability and ask, are we earning the same operating profitability either when we're selling other products, but often what we're saying is, do we earn the same operating profitability as other distributors who are distributing similar products in a similar manner, offering similar services, in which case we'd say, well, we should probably earn about the same operating profit as they would earn. Now, of course, it wouldn't be the exact same dollar amount. We'd want to measure that relative to something. We often measure it relative to either sales, so the operating profit over sales, which is the operating margin, or relative to assets, the operating profit over the average operating assets, to show a return on the investment that the company has made. And we compare those to the returns that other firms earn and say, does that show us a defense that we aren't overpaying for the goods because we're earning about the same profit as other people who do the same thing? Now, we don't have to just look at this from the distributor side. We can also ask the question, what if we took a look at this from the manufacturer's perspective? Well, we already talked about the cup, and that would work equally well from either side because it's where both this buyer and the seller come together, what price they determine. But let's think about, from a Japanese side, what if Japanco sells similar goods but not identical goods? If they were identical, we might be able to use the cup. But if they're selling similar goods to unrelated parties, could we compare the gross profit earned on those sales to the gross profit that it earns in sales to related parties? So in this case, we're saying they earn a gross profit of 30 and they had a cost base of the cost of goods sold of 40. So we might do this by looking at that ratio of 30 over 40, which is sometimes referred to as the cost plus. The cost plus method, looking at this markup above the cost of goods sold, if we're earning that same margin, whether it's a sale with related parties or unrelated parties, that would be fairly strong evidence that we're earning an appropriate amount of profit. That means we're selling it for an appropriate price, a price that would be struck between parties who were arm's length to each other. We can also look at the operating profit of Japanco and ask the question, are we earning the same kind of operating profitability that a comparable manufacturer is earning? This might be most appropriate if we don't have a high degree of comparability between a product we're selling to a related or an unrelated party. Maybe Japanco sell all of our product to related parties. But by looking at the operating profit, it might be pretty fair bet to say we could find other manufacturers who are producing similar type products. What kind of returns do they earn? How would we go about measuring that? Well, we often would measure it as either a markup above their total costs, which would be that operating profit of 10 over their total costs of 60, the cost of goods sold of 40 added together with the operating expense of 20. Or we might look at it as a return on their assets. In other words, they're earning an operating profit of 10. Is that a reasonable return on the assets that they're putting at risk in the business that they're conducting? Does it meet up with the return on assets that other manufacturers are earning in the same market, making the same types of goods, etc.? Well, that was a quick overview of the basic transfer pricing methods. Thank you, have a good day, and I hope you enjoy the other videos in this series.